Effie deals on the rise, flipping those dreams before your eyes. Listen and learn, she'll guide you through. If Effie can do it, you can effing do it too.
Hello, everyone. Welcome to another episode. I am 4 times honored today because I have 4 people with me. So I'm super stoked, and I want to say thank you to each one of them. Of course, we've got Raz Mihalyi, my partner, not last or least, but first. And I thank him for being here. Jamey Marcos, thank you so much. I love your podcasts and your social media. I feel a little embarrassed compared to you, but I'm grateful that you're here because of your experience, which we'll touch on in a second. Thank you, Jamey.
Awesome. Glad to be here.
I'm glad you're here. Josh Smith, thank you. You're one of my favorites, and you didn't think I liked you.
Glad to be here, Effie. Thanks for having me on.
Thank you very much for coming. And Julian, you and I have done business. You've been on before, and I also always appreciate you. So thank you for coming, Julian.
Yeah, thank you for having me, Effie.
All right, everyone. Today we are here to talk about transactional funding. And what it includes and how different people approach it and who's doing what. So at this point, I'm going to ask Raz to tell us what is transactional funding and to throw out our first question.
Yeah, so we actually have 3 transactional funding teams here, and we are going to go around and have a conversation about some of the practices. But first, to just define transactional funding for those who may not be aware, it's a type of lending structure that is used in real estate transactions to get them to close. And there are various different types. There are earnest money deposits funding, there is funding for double closes, and there is funding for other more creative structures that come under various different names. You might have heard them under Morby method, stack method, seller carryback, bridge equity. They all talk about the same thing, and we'll dive a little bit into that. But this is what we're talking about. We're talking about funds that are held in escrow for the purpose of closing a real estate transaction. And some of the folks here are providing those funds, and there are various ways in which we can do that. We all have our different processes and our differences, which we'll touch on in a little bit. But to get us started, I'd like to ask Jamey to go first and to tell us a little bit about your experience, Jamey.
And also what he does, because you haven't identified yet.
Yep. You can talk about what exactly you focus on. What was your journey getting started? And let's start there.
Cool. Yeah, I am focused solely on transactional lending right now as far as real estate's concerned. And my journey to that, what I do now anyway, started in wholesale. So I started as a wholesaler, started in real estate through the sub 2 community, probably around the summer of 2022. That's when PACE created the Gator program. I took somewhat of an interest there, but then got, dragged away by the shiny object of wholesale and started learning that, got my feet wet in that. We started building a team, and I don't discount it for any reason at all, because that's where I learned how to negotiate. I learned creative deal structure. I got really good at it when we were closing deals and stuff. It just didn't work out for my family personally. We homeschool our kids. My wife and I also do have a media business. So my attention was just 100% wholesale, and I had to change something about that. So looking into transactional lending, 2024 is when I took it on full time, basically. And I've been doing that ever since. So I can do that as a solopreneur for now, and found that, the models that I follow after anyway, showcase a lifestyle where I can grow to a pretty decent level on my own and then start outsourcing. So that's where I'm working towards right now.
That's awesome. And I know that you're also coaching, helping some folks get started. We're all part of similar communities. What would you say to someone who were to get started in transactional funding? Maybe they have a small set of funds set aside that they want to leverage. How would you recommend that they would get started?
I think Initially, it's just evaluating your resources. So like you said, if somebody was starting with a small amount of funds, that will automatically tell you what types of deals you can go after. And once you've honed in on that type of deal, it's very important to stay focused on that type of deal. So let's say if you had $5,000, you could probably stick to just EMD. And because you would narrow focus on EMD, you'd only be searching for EMD deals, who you can fund, who's already doing them. And now you start down your lead generation path. Whereas if a person had, say, $100,000 and they wanted faster money in transactional lending, right? You could probably start in the double close route, just learn double close because it's a faster transaction, less risk in my personal opinion. But you could go after that. So evaluating your resources is where I would tell somebody to start from the very ground up, but then it moves directly into your lead generation after you've evaluated those resources for sure.
I'm going to ask us to just move back just a teeny bit because you talked about earnest money deposits and double closes. For those that might be just joining the channel for the first time, can you briefly describe what is EMD and double closes? How do they work?
Sure. Earnest money deposits are a deposit that anybody can put down when they want to put a property under contract. So the earnest money showcases their intent to purchase that property. It shows that they're serious. So that's what earnest money deposit is. A double close is basically a wholesaler coming in, purchasing a property, and instead of assigning the rights to that contract to an end buyer, they are now purchasing it on one contract, which we call the AB contract, and they're selling it on a completely separate contract, which is your BC contract. That is a very basic definition of double closing.
Why would someone do that?
Typically, people are looking to, if they're selling it at a decent spread, the assignment fee itself is very large. They like to keep anonymity between themselves and the buyer, right? To not distract them from the money that's being made. A good wholesaler will help that buyer understand how they make money in the transaction and how much they can make so that they feel comfortable about that purchase, regardless of what they locked it up at, let's say, on that A to B contract. So anonymity is the main reason for a double close.
All right. And since we're on the topic of education, and it's very important, thank you, Effie, for highlighting that, because some folks might be joining who are new. I'd like to segue into a question to Josh, because I know that he's doing a great job educating folks on how to leverage their funds and get into some of the deals that you're part of. Josh, could you tell us a little bit about your process for educating the clients that you're working with, borrowers for transactional funding? If they have any hesitation over that, how do they overcome it? If you can speak a bit more to that.
Yeah, no, definitely. Thanks again for having me. But yeah, so as far as the transactional funding product that I work towards mostly, it's more on and I know Jamey and Julian and really everybody here does this product, but this is like the main one that I'm focused on. So it's called a stack. Well, we refer to a stack method. Sometimes it's referred to Morby method, seller carryback, so on and so forth. So that's where you come in as a buyer and you negotiate some type of seller carry back terms. So it works most ideally when the seller has about, say, 40 to 50% of equity in the property. That's where this method works pretty well. And what you're doing is you're coming in with some type of traditional loan. Usually it's going to be an investor loan, so a DSCR. And then you have us as the transactional funder fund that down payment. So the first leg of the transaction, it's pretty much your standard real estate transaction. You get it to the close, except we're funding your down payment. Then you have a secondary transaction where you're essentially doing a HELOC or a cash out refinance of the seller's equity in the property. That pays off your transactional funder in that case. And with that type of product, you're getting into the purchase with little to no money out of pocket. And in some cases, you can also bring in an acquisition fee on that. So it's a way where you can scale at a much faster pace. So as far as education on that, I definitely, you see the whiteboard in the back. I'm a much more visual person, so I like to draw it out, stick figures and all, keep it as fancy as possible. But yeah, that's primary from the education. And I also, what's really important to me is it's a complex transaction. So I don't take that lightly. And then also just making sure that the buyer, like they have some awareness to real estate from the get-go. I don't believe this should necessarily be your first transaction, but one, making sure they understand, hey, these are the risks involved. You want to make sure that one, you're protecting the seller first and foremost. Two, you need to understand what your exit strategy is, because you're over leveraging the property in this scenario. So you want to ensure, okay, how much am I over leveraging this? And at what point can I refinance out? Like when is that appreciation of the property going to catch up to that? So you want to make sure that you're planning ahead, because yes, you may get into the property for little to no money out of pocket, but at the end of the day, real estate is expensive. So you need to account for that.
And I think as we start to get into this discussion more, our listeners are definitely going to understand, if they don't have this already, just how complex the stack method or seller carryback or mortgage method, or we got to come up with one name.
At least for the purpose of this conversation.
Yeah, at least for the purpose of this conversation. What shall we call it for this conversation?
I think stack, or I mean, even just seller carryback, because you're
Well,
essentially, you're just stacking loans on top of one
okay,
another.
so stack works for us. And I think that as long as newbies make sure they understand the difference in these, like that they're basically very similar, but extremely creative, that will serve the purpose. So we will definitely come and delve into this deeper. But I'd like to address Julian at this time, because Jamey and Josh, as well as Raz and I, are doing transactional lending or transactional funding. And Julian may as well, I don't know, but his reputation and his history is that he's known as a DSCR lender. So that is the first leg of the transaction, which Josh just described. So Julian, could you describe to us how that first legs works with you? And do you ever work directly with transactional lenders? And if so, what does it look like? You know, bring us into that.
As you all know, I'm focusing on the primary loan, the first lien position loan. And when I have a need of transactional funding, I'll probably reach out to you guys to partner up on those, which will be great. And the biggest challenge I see that's happening every day to me is when the borrower come and say, "Hey, can you do seller carryback or mortgage method?" I said, "Yes, I can. Can you?" And the reason is that a lot of investors don't understand the mechanics of how this is really happening and how this need to happen properly. So to have a successful closing, they have a wrong expectations. They're looking for something that doesn't exist many times, and that's create quite a bit of a stress and tension between the parties, right? Also, sometimes we don't even know until later that what is the actually the situation and what the intention and what is the setup of the closing, and we're finding later that, oh, by the way, we're using XYZ funding. I said, okay, but this particular lender might not do that. Or, hey, if you're going to use transactional funding, we need to use a lender who actually allow that or don't have a seasoning on the funds required for closing. But many times we don't know this in the beginning and we find out a little later, and that's create delays. And also many times, unfortunately, deals are not closing because the people give up, like going somewhere else just to find out the same information that we'll provide. So we work with extensive amount of lenders. So if we know what we need to accomplish, we'll go and work with the lender who actually is the best fit for that. And that's the importance of super clarification day one, what the transaction look like, who is involved, how we can work together as a team to make it happen. And yeah, that's what now we ask more questions in the beginning just to find out the full story. Fortunately, we're getting lately a little bit more success on those transactions just because we're identifying early what the problem is. And at least if it's not possible to arrange what we need, then the borrower need to figure out another way to do it. But yes, we can definitely accommodate all those transactions all the time as long as we do it properly and with understanding what exactly look like.
Okay, so I just want to jump back in here for a second to make sure I reiterate what I think I heard you say. And if I'm correct, as we've all touched on already, stack method is complex. It has many moving parts, and the ideal sequence for investors would be to start with your DSCR lender and be upfront and to tell them, hey, I'm going to be doing a stack on the back end of this on the second lake. Is that correct?
Yes, but mainly because the first transaction will close as a normal transaction. That's what people don't understand many times. So the first transactions should be absolutely same as any other DSCR transaction. The main problem arises when they don't have money for closing for the normal closing, and they need to somehow figure out how to get the gap. So now we of course have DSCR lenders who allow gifts, who allow no seasoning on the funds, and then in this case we can have the transactional lender to direct funds to title and close it that way. But if we don't know, and if we use a lender who need a 60-day seasoning or 30-day seasoning, then the transactional lender somehow need to send the money to the borrower account, which not always possible or available. It's 30 days is a long time.
Nobody in this room will do that.
Yeah,
I think.
exactly.
Right.
So,
So
So-
the first place where people trip up is not understanding that the transactional funding part, as far as you're concerned, some of your lenders will say, wait, it has to stay in there for X amount of time, or it's
Yes.
got to be in this under a certain structure, different, whatever they choose. So that's the part that trips people up. The first part that trips people up.
So the easy way is when we are dealing with sophisticated investors, because they might have other properties where temporarily they can actually do a cross collateral, and that way, not a problem. They can borrow gap funding and give a collateral something else that they have with equity. Then they will get the money into their account early enough to show that they have the money in their account. And that's obviously the ideal situation. Or they might have their own assets, which they can use for the actual closing, and then later just reimburse once they close on the second transaction, which is a cash out, a refi, and recording a second lien from the seller funds once that happen. So those are the couple of options that can happen, and depends on what the ability of the borrower is. Then of course, if we know early, we can work together and kind of identify which of those options we can exercise and will be the most streamlined for them.
Yeah. Okay. So Julian, you're saying that you also have a lot of lenders that you work with, and you have different options, because I know that Jamey and Josh, I know their process. It's very similar to ours as well, where for 30 days, as I said, we wouldn't provide transactional
course.
funding for that. But I know there are lenders out there who don't require seasoning, right?
Yes,
And you have
that's
access to
correct.
those as well,
Yes, that's
which
correct.
is great to know. Yeah. From your perspective, what are some of the things that transactional funders should communicate with you on? As you mentioned, the borrower, that they should be upfront about what they're doing. What is your relationship with folks like us? Where do you communicate? What do you need from transactional funders in general?
I don't need something on a day one. However, the earlier the better to know who is involved in the transaction and work on the mechanics of how this can be documented. So if it's a gift letter, right, just we need to execute that way. And most of the lenders have their own forms for that. And we can be ready ahead of time with that. I mean, that's pretty much what
Got it.
will
So I'm
happen.
hearing that most of the communication needs to come from the borrower side rather than
Yes,
from the transactional.
yes. But of course, we can, if the borrower connect us on a timely manner, then we will have enough time to execute correctly instead of being rushed in the last minute and everybody stressed out.
Jamey, I would like to come to you if I may, because I know you've been doing it for a while now. And a lot of times transactional funders or lending are the ones that save a deal. I'm kind of curious to know if you've had any dramatic rescue stories where, transactional lending, you came in as a transactional lender to save a transaction that was going to fall apart.
I don't know that I've saved a transaction that's going to fall apart. I think the process in a stack deal, I don't know that I've saved the deal, but definitely worked through every single problem that we've had from start to finish. Making sure I address each barrier in a stack deal specifically. As far as EMD, not so much, because people that are desperate for money at times are the most risky, and they're typically coming to me without starting a relationship. I have no idea who these people are. They're looking for money really quick, really fast, and they just want things signed. So I try to stay away from those. I have done kind of like double closing with buyers actually who double close it to themselves. And the way that we do that is basically double closing in one LLC so that they can purchase the property. Sometimes, like in the case that this happened, a buyer that I work with constantly, she was purchasing a property in her neighborhood, got it at an amazing price because the agent couldn't sell. She obviously walked over to the house, was like, "Hey, I'd like to buy it at this much. You haven't got any bites. There's nothing happening." Got it at a sweet discount, but had to close very quickly, like quicker than her primary lender could fund. So we injected the funds, did it somewhat like an extended double close, and basically bought the property for her and then double close it with her lender on the backside. So
Sweet.
stuff like that, that would be like an emergency situation that saved a deal.
Yeah, I would call that a rescue. How long did you have to double close? How long was your money held?
That one was held for, I think, only 5 days, and that was over a weekend. So technically like 2 business days, maybe.
Yeah.
Yeah.
Probably someone that didn't just knock on your door and say, "Hey,
No,
do you have some money?" But
there's
rather
no way.
someone you worked with.
Yeah. Yeah. People do that. From what I've heard, I will not. This person, I mean, we break bread together, so our families get together for barbecues. This is like a very close relationship. So that is a circumstance I would do that. As far as like saving deals, we are constantly saving deals on these stack method structures to help the buyer get through. Like Julian alluded to, this is a very savvy investor, complex transaction, right? And so I don't think it's a complex transaction, like the structure of it at all. I mean, you're literally just stacking primary financing and seller carryback financing. That's literally it. There's only two sides to this transaction. The complexity really lies within those small transactions inside that one transaction, right? Like the ability for your buyer to communicate properly to their primary lender, their ability for that buyer to communicate with the title company about where the funds are going to be going for that second close, what that second close actually is, so that they're not raising flags for no reason, right? So addressing all of these little transactions, I think, are the deal saving mechanics of this one complex transaction. And at any point in that, addressing one of those problems could just totally kill the deal, right? If they did not disclose properly because of my wrongful education or something to that buyer, and the buyer not disclosing to the lender that they have third-party funds coming in, that could blow up at the closing table. And we would, as transactional lenders, we would have no idea until the closing table, because we tell them to disclose, right? Why didn't you disclose? What happened? And if you find out that your buyer, was lying about it, then hey, the deal falls apart, right? So little transactions within the big transaction, I think, is the complexity that buyers should be addressing, and knowing whether or not they have the wherewithal to deal with those types of problems.
That's cool. And now just going the opposite way. So you talked about how you salvaged the deal in that case with the extended double close. Because you've done quite a few of these deals, what would you say is something that you saw done fundamentally wrong, or some of the gotchas or the pitfalls that were very surprising? I know that I heard at least one of those stories in the past from you. It could be either double closing or a stack method, where you saw maybe some some case of a title company doing something wrong or a title company being impersonated. But we've seen plenty of those. I'm just curious if you can share some of the war stories that you've seen.
When it comes to the stack method types of deals, I think that is all upfront. I think 90% of the problems, I would say, can be fixed up front or addressed up front, because that's all about communication and how things get communicated up front. This is the type of transaction. This is where it's going. This is title's role. This is my attorney's role. This is what my TC's role. This is the primary lender's role. This is what the primary lender is asking for. This is what the transactional lender is providing to that primary lender, right? So everything happens up front. And once you're going through it, now you're not like coming up with problems. It's really just referring back. Hey, remember we told you to disclose at this point in time. Hey, remember we told you, let the title company know they need to do this at this time, right? So everything can happen up front in a stack deal, and then just addressing and referring back is the problems you'll deal with in a stack deal. On a double close, like you said, I think the biggest hurdle to look for is the title company, fraudulent activity, fake websites, fake agents. I think this wasn't mine, but the last one that I heard about was a title agent who no longer worked at that title company, right? But they used the name, created a fake website, and then they almost sent in funds. I think that was about $250,000. And the hard thing about that, right, is it makes you feel like you're not a very trusting person because those things happen to you, right? And so I had one just the other day where we're vetting this title company and this title agent, but it was a title company I already knew and trusted. I had met them in person. So it's a little odd for me to still go through my process, but I think the processes you put in place are what you'll always be falling back on, right? Your business is only as good as strong as your process that you've created. So that would be the double close. EMD is a constant learning. Those are big. Those are risky because the money doesn't go in and then come back out. The money goes in, it waits, right? And it goes through the entire process. And you have to know up front, again, that you talk to the title company, that you trust your buyer or your borrower, right? The one that we're in right now that's just about to go to suit, this one was a earnest money for an end buyer on a double close. Actually, I take that back. Probably the most creative thing you guys have ever heard in here anyway, but it was earnest money for the end buyer on a double close with a stack method on the BC.
So all 3 in 1.
Yes.
Oh, whoa.
Yes.
In theory, you get paid 3 times, right? 3 different ways.
You could, right? But this is with three partners, three transactional lenders actually, and I actually turned this one down as the EMD for this one. I just didn't want to go about raising the money. Somebody else came to me, wanted to do it. They knew that I had a process and I knew how to TC these deals, so I did the back end work of just TCing it, right? And I'm ending up doing all of the work on it anyway, because this thing is about to go to suit because of the title company. So we had all of our I's dotted, T's crossed, like double time. Everything was signed down to the T, right? Everything was good. We got all the confirmations we needed. It was no problem of my buyer, no problem of the seller. It was literally the wholesaler who was double closing. And then the title company created one escrow for a double close, which is illegal. So
it's not a double close.
We found that out. And so because of that, when my buyer dropped out, he said, no, I don't like the deal. Some things changed. I don't want the deal anymore. So we canceled within the inspection period. Everything, like I said, was by the book. But because we canceled, the seller made us think about it and said, hey, I want my earnest money. And we said, well, that's cool. Go sue the wholesaler. Go get your earnest money. But we found out later on through this diligence process that the title company only kept one escrow, and that's where our earnest money went. And so the seller thought that they could get access to our earnest money. On top of that, the title company created a earnest money receipt for my funds in their escrow. And we got all of the records through all this too. That's how I know it. I'm not guessing, right? So this is just a process that you have to go through, because even if you do want to go to suit or you want to stop it from going to interplead, and you have all the skills and you dot your I's and cross your T's, things can still go wrong. I think that's what the biggest takeaway. And if you're not willing to deal with what can go wrong, then don't do it at all, right? Learn first. It's like people getting on second position gap loans. If you don't want to take over the flip, don't lend second position gap, right? People don't think about that. But it's the same thing with transactional lending. If you don't really know the process, then don't get into the deal. And because there are things that can go wrong, like this deal, I fully accept what's going on because there's a process. I did everything right. I will eventually get the funds back. Does it hurt to go through the process? Because it is a waste of time, a waste of resources, right? Opportunity cost, which is everything we're suing for. But that's the process. And now, to me, as detrimental as that might seem to somebody new, this is kind of just a laughing matter for me because it's like, why are we in this? Like, I did everything right. I'm perfectly fine. The money's eventually going to come back. We'll be good. Even my capital partners, like, what is going on? But as I explain it, as they're right up front, everything is out in the open. When people work with me, I think that's the key, is the relationships and the openness, and people learn to trust you even through things going wrong, right? Because they always will, and they can. So, yeah,
And they're not going to be predictable, because that was a bit of a crazy story for sure.
that's right. That's right.
So I'm going to go to Josh next, if I may. I'm curious, Josh, if you could tell us a little bit about when a new client comes to you, how do you evaluate that? Not just the deal, but the individual. How do you evaluate their character and trustworthiness as to whether you're going to take them on as a new client, or I'll pass?
First off, I definitely want to touch on Jamey's point that Murphy's Law in transactional funding, if it can go wrong, it will. It's just part of it. And stack methods are definitely not an exception to that rule. There's each deal has its own little nuances to it. I think Jamey can probably attest to this as well, that there's always something different that comes up between each transaction. So it's interesting to see that. But as far as vetting new clients when they come on board, what I've been trying to do, I've been trying to put a lot heavier emphasis on the education side of things. That way it does kind of some pre-lead qualification to a certain extent. So usually when they're coming on board, they have a general understanding of the transaction as a whole, kind of through some of the education content that I put out. And what we do is we typically set up a one-on-one call, and then I go through the numbers on, hey, based on what you've negotiated with the seller, this is what you're looking at from a potential money back in your pockets standpoint. This is what you're looking at as far as how much you're over leveraging the property. Also, from a standpoint, if you are on this time horizon, say 5-year balloon, 7-year balloon, this is what you're going to end up paying out, or in some cases, you're in the clear. So they just need to be aware of the full scope that, hey, this is really underwriting's on that's on your part. That's not my part, but I just want to make sure that going into this, you have full awareness to what you're doing. So that's the primary thing. And then ensuring that they know that if they're working with us, it's going to be full transparency. Like as Julian mentioned, as Jamey mentioned, you've got to disclose and you've got to be transparent with all parties that are involved in these transactions. That's the way they get across the finish line. That's the smoother. They're not fully smooth, but that's the smoothest transaction that you're going to come across. So yeah, it's primarily just the education up front, vetting them through that. And when you talk to people in that setting, you get a pretty good feel on their knowledge based on what they come to you with. Because I've had one that she came in the other day and she came in with like a full underwriting on like, hey, this is what it's going to make. And then the one thing she didn't fully grasp was how much she was going to be over leveraged. It's like, oh man, that's huge. That's super beneficial to know that, because now I know that I need to refinance it at, say, a 7-year term instead of a 5. So, yeah.
So then she can go back and renegotiate with the seller. Yeah.
And again, I also want to stress that from a transactional funding perspective, that's not necessarily our role. Like we're not here to underwrite the deal, but I just want to make sure with these type of transactions, to make sure all parties are kind of self-aware of what they're getting into.
Yeah, I did want to touch on that because I heard both Jamey and you mention that aspect on coaching the borrowers through the process, through the transaction, because it's not something that is typical, right? Even if someone is a more seasoned investor, they might do it in a more traditional way, or this type of creative way of structuring the deal would be newer to them, right? So I'm hearing that part is important in both your businesses.
And I think one thing to like Julian's point is, I mean, maybe the buyer or the borrower, same thing. They go to a DSCR lender, but they just don't necessarily know what to say. because even if it's a savvy investor, maybe they haven't done this type of transaction. So it's important to have some of that coaching on the front end, so they can even know, okay, what do I disclose? I'm not 100% sure what I need to be asking for when I'm talking to the lenders. I think that's definitely helpful to connect with a transactional funder on the front end to make sure you have some of that information going into it, as well as while you're like in parallel working with the SCR lenders to see, like, shopping around, what are your rates going to be, so on and so forth. And it's always a situation, if Julian, like, I think Julian in a lot of cases is going to be able to do it, but say it's another lender and maybe they don't have the connections that Julian has. It's one of those things that we have access. I mean, I know everybody in this room, we have access to other lenders that can accommodate these type of transactions. And it's really not that difficult to swap out a DSCR lender if necessary.
Yeah. And I know at Mundo's mastermind, it was interesting to see him actually calling title companies. And why wouldn't you also call DSCR lenders and say, hi, I'm interested in knowing, do you know what a stack method is or a mortgage method? Do you do them? And just get to the basics. Oh, you don't? Okay, thank you. And find the ones that say, oh, yeah, actually, we do that, or we have done that, and work with them, because it is complex and it's not easy, but it's a really wonderful tool when you think that you can get into it with a minimal amount, that the buyer can get into it with a minimal amount.
Yeah. And I think that also brings up another good point, is not all transactional funders are the same as far as how they're going to operate with you. So they may have, there's going to be differences in their process. So there may be some where you could get a different type of loan product based on how they accommodate the transaction. Like, you may be one where they'll come on your operating agreement or your LLC. That's something that I won't do on my end. I don't believe Jamey or others in here will do. But again, you're going to be working with different transactional funders, where to just make sure you're familiar with what their practices are and what questions you need to ask with your primary lenders, because it can get done both ways. We just want to make sure that we're, one, helping you to the best of our ability, but also not overly exposing ourselves at the same time.
Right. And did you say that, Jamey, you do get on an operating agreement, or that you don't? Yeah. Okay. We don't either. But
Yeah,
I'm sure there are some that do.
Yeah.
Yeah,
Well,
actually,
like Julian wanted to say something, so go ahead.
yeah. So actually, there are two sides of that. Like, for example, there might be some lenders who has a way better terms. If you have not need to use a no seasoning or 100% gift as a fact in the transaction, and for that reason might be more beneficial for the buyer to get the capital partner as a minor below 19% on the operating agreement temporarily until the loan is closed, and then after the fact, we do amendment to the operating agreement and record the lien later. That's another way. I'm doing both of those, no problem. But again, if we need to know, so we know which lender to use, and go back to the title companies. So many times borrowers don't even understand that this title, XYZ title company, may not even know anything about it and cannot do it. Also, back to the calling DSCR lenders, 99% will not even know what the question is. So that's for sure. And then, so all these need to come together. Specifically in Georgia, there are quite a bit closing attorneys that will not facilitate in one place the mortgage or the stock method, just because they say, I talked to many different attorneys, and they said, hey, we represent the lender and we may lose our license if something go wrong. So that's why a lot of closing attorneys and title escrow agents are hesitating to do this on one place.
What do you do in Georgia in those cases then? Do you just not do them in Georgia, or do
No.
you,
It just usually it's take place in a different closing attorney office, the second transaction, and not.
Okay, two different locations?
Yeah, for the second transaction, for the refi, and get a loan from the seller. So
Yeah,
of
I
course,
was going to say that I think the stack method in general, as we know, because we've gone through several trainings on that topic, can be done in a wrong way. And that is the way that most title companies or closing attorneys are worried about. But it can also be done in a right way, which is what we're talking about with the second transaction that is essentially a refinance on
yes.
that equity. So with that, there shouldn't be any problems because the two different transactions are types of transactions that title companies or closing attorneys do day in and day out. And they're very standard. It's just a matter of
Yeah,
changing
but
them.
they have a problem to knowing and not disclosing to the lender the second transaction. That's the biggest challenge for title and attorneys.
So if this deal is not disclosed to the DSCR lender right up front, then that's where it fights them. Whereas if you had,
But cannot be disclosed because the times of 80 or 90-10 are gone. I was during that times a lender back then 20 years ago. It was super easy, no problem. But even today, or even back then, but even today, like for example, even conventional loans, there is no problem getting a second lien. No problem. It's not forbidden, but you cannot do it on a closing transaction because you qualify for a certain loan to value ratio, and this is what your approval is based on. So you cannot close concurrently on the same transaction. You need to do it one after another. So that's kind of similar to the DSCR loans. It's like you qualify at 80% of loan to value and you need to close at 80%. What's happened next, it's another story. But uh, if somebody can give you even 50% more, that doesn't matter. But the original transaction need to close as exactly as was approved and what the terms are.
so we're starting to close in on the hour, which it's gone fast, that's for sure. And I would like to start with Jamey, if that's okay, and ask, what's the biggest transactional lending mistake that you have seen, uh, or has happened to you? And, what would you caution most beginners about?
You said the biggest mistake?
Yeah. What sort of things go wrong repeatedly as far as you're concerned? And, what would you bring awareness to beginners so that they don't fall in that um,
I'd say the biggest mistake that I've ever made is just trusting people over a process. That will always be the falling factor. And this is with people I know and trust as well, right? And just giving them the benefit of the doubt. We all want to do that. It's our humanly instinct. But when you take precedence over that, in business anyway, take that over precedence to your process, like in my experience, you'll lose every time because there's something that's going to go wrong. Like Josh said, if it can go wrong, it will go wrong, right? So if you plan for that instead and you trust your process, I've learned to now communicate. I would do that because I was bad at communicating my process. And that's what I started learning after a while. And this is how I overcame that mistake, right? Is I learned my own process. I wanted to stick to it. And so I had to come up with ways to explain it better. And I found that that was a failure of mine, is just if I can articulate, here's my process, here's the way it exists. This is why I charge an upfront fee. This is why I vet a title company. This is why you might experience a delay at this portion just before I fund, right? Very specific to my process, but very specifically communicating to my borrower. That's been able to overcome some of those bigger mistakes in trusting people over process. So that'd be like a continuous kind of thing. The biggest mistake that I ever made is just not knowing enough when I got into it. That's all. I didn't credit enough to my learning. And when I found out, okay, I understand the process. I understand what EMD is. Here's a simple contract for it. Okay, cool, let's do it. And then it just went into it, right? That one has been lost now for the last 3 years, right? I just never came back. I'm like, there's no way for me to chase it. It was kind of basically just hard money because I had no idea what the contracts meant, how it could be enforced, whether or not it was even enough of a contract, right? So that personally was the biggest mistake of mine, just getting started ahead of my knowledge base, I guess. And then the consistent problems just being people over process. That's not something you want to depend on. You want to depend on your process first.
very Very nice. Thank you.
For sure.
Yeah. Thank you. Josh, I wanted to ask you, I know you have an interesting story where you are both doing transactional funding, but you're also buying assets, which Effie and I have been also talking about, where we're pretty excited about leveraging the stack method in acquisitions. Can you talk a little bit about some of the assets that you have been looking at with leveraging the stack method from a buyer this time?
Yeah, no, definitely. So I think for me, and I think Jamey's like this too, which is what I really like about Jamey is we try to go after the most difficult transactions. We like to experience the pain up front and
Like
be
a
kind of
challenge?
on the cutting edge. So that's definitely no shocker there from the transactional funding perspective. So I've been heavily focused on more of the commercial products because that is a more difficult transaction to get. Also a longer time horizon, but it can be a more difficult transaction to get across the finish line. One, because you're also dealing with extremely savvy, or more often than not, more savvy sellers and buyers. So that's just one of those things that you need to be really honed in and know, like, it's kind of what Jamey said, just going through that process of honing in what your processes are, but also how you're explaining those to your clients. So what we're looking at right now is more in the mobile home park space as well as the RV park space. So we do have one that it's under contract in South Carolina. That is going to be a Marby method. We've got a couple others that they're more on the seller finance. But what we do is we're trying to do a variation of the two. But I'd like to, between assets, I mean. So we've got some that are seller finance, one that's Marby. And for me, I want to make sure that I'm experiencing it on my end. That way I'm not testing the waters on a client. So that's one thing. Since we are going after that asset class, I want to make sure that we kind of really hone in that skill before we're broadcasting that and be like, hey, we can get these done for you. I'm not a firm believer of like, oh yeah, I can just do it when you haven't even done one. So that's the main thing. Proof in the pudding and proof of concept, and get that across the finish line. And then there's always going to be learning points above and beyond that. We're not going to come across everything you can come across in that type of transaction, but we want to make sure we have a very solid grounding moving forward. That way we can kind of help lead the space in that regard from a commercial side.
Yeah, that's awesome. And I just wanted to add on top of the question that Effie asked you before about educating your borrowers and vetting them and so on. I know that you have a pretty cool story about the borrower who reached out to you for transactional funding, where you guys closed some deals together and now you're becoming partners on some of these acquisitions, which is really awesome to see.
Yeah. So this is, yeah, I think you're thinking of Lawrence, right?
Yeah.
Is that correct one? Yeah. So no, he was coming to me originally going after some single family portfolios, and I was our relationship or our partnership actually kind of started from that, was kind of going through educating him on the process, and he's an extremely savvy investor, so that also helped me from my standpoint, honing in my skill, making sure I'm explaining it in the right manner as well. So yeah, no, there was a few transactions that we were going through out in California. I give him a hard time all the time. He's a glutton for punishment and likes to go after California. But yeah, we were working on some portfolio loans for him on that. And then we've kind of morphed into, he had seen that from my standpoint. So I own a property management company south of Nashville, and a lot of that is transient or hospitality based. So an Airbnb, monthly furnished rentals. So for me, my way of getting into multifamily is getting into RV parks and mobile home parks, because there's an aspect to that that's more in the hospitality industry. And I feel like I've got at least some, it's no matter what, it's going to be a learning curve, but from that standpoint, maybe less of a learning curve, and it definitely provides some value there. So, but yeah, no, we're excited. We're going full force into that. We've got one that closed this past Monday, 2 under contract, looking to have at least 5 under contract by the end of this year, and then 15 next year. So we're forming the team, and it's rocking and rolling.
Congrats. I'm going to come to Julian next and ask him, Julian, when you're dealing with transactional lenders such as us, what kind of documentation or preparation do you like to see in place, which would make it easiest for you to accommodate?
So depends on which way we are doing this transaction, as a kind of capital partner on the operating agreement, or as a gift letter. That will determine what documentation we're going to use. Obviously, if it will be as a capital partner, we need to execute the amendment of operating agreement and present this to the lender to show that it's a minor partner coming with and supply down payment, or the gift letter that is a standard form that we need to have in place in order to document it. Okay, this is the gift coming from XYZ source, and this is where to expect the money will arrive at closing. It's just a title company or a closing attorney office. So those are pretty much the two ways we do.
Let me ask quickly about the gift part, because none of us here use gift letters, and I was under the impression that the whole gift concept was something that is applicable in a family relationship type situation, which this, of course, is not. 99% of the case. So how does that work? Are lenders okay with that, with a gift from
Yeah, it
third
depends.
party?
So they might have, but here's the thing. They can execute the proper documentation between them, even though there is a gift, right? The gift letter is for the lender, and then their additional paperwork can be in place and give ability the if the money are not received after closing to record the lien. That's how it is.
Okay, so you have some lenders that are doing it that way. Interesting.
Yeah, I mean, it's otherwise it's just yes, even if there is no seasoning on funds, these funds need to come from the borrower. And how to come with it from the borrower when it's coming from ABC? So it's kind of a little bit of a complex situation which need to be. I don't know how Josh and Jamey, maybe they can elaborate a little bit more how they were able to do it with others, but that's what we see and what we do.
So I think from our I think a lot of the ones on this call, from our standpoint, the way we accommodate it is so the lenders are obviously going to want that to come from the purchasing entity or the buyer. The way we accommodate that is through the buyer's bank account. So, but we have processes in place to where we have complete control over that during that. Because I mean, one of the most important part on our end is just ensuring that, one, we're protecting our funds, or if we have a capital partner involved, we want to make sure that we're over protecting those funds even more.
Exactly.
But yeah, we do accommodate it through where it is coming from the borrowers, and that's one of the things, is one of the first calls we make when a deal comes in and we get it approved, is we're working with that primary lender and informing them of like what our party is to the transaction and how we're funding, so they have awareness to that. So I think the most important.
So that's great. Yeah, that's great, because that's actually the cleanest way, right? Because there's no question marks, and there is no need of letters and everything else. That's absolutely correct. But a lot of people are not organized to set up this correctly up, ahead of time, and that's why in the last minute we do whatever we can do to accommodate. But it was definitely super easy to open another account, a completely separate account on the entity. It's opening for one day, and have the money there and to going through there to the closing, and then there is no questions asked.
Yep.
All right.
Jamey has anything else to elaborate on that? I know his is pretty similar.
Yeah. Yeah, that is how we do it, Julian. So, I mean, really the box that we're checking with that is the sourcing requirement. So, I mean, you're aware of that. So as long as what I like to preface the conversation with, both lender and borrower, is that we look for lenders that allow, like just one layer deep sourcing. So from escrow, what account is it coming from?
Yes.
And if we can check that box for them and they're okay with that, then that's cool. Now, if you source 2 layers deep and you go into that purchasing LLC account, and then they say, okay, we just saw an injection of funds into that account. Whose funds are those? Now we're getting into 2 layers deep sourcing and some seasoning requirements, right? Because now you're vetting the person who contributed those funds. So the way that we address that is pretty much also upfront with the disclosure saying that, here is the proof of funds. This was provided by my capital, and it's exclusive to this borrower for the purchase of acquisition costs and purchase of property X, right? And so that type of language is in our disclosure email when we deliver those proof of funds. So we automatically strike the sourcing requirement, we negate the seasoning requirement, and we provide disclosure who we are in the transaction all in one fell swoop.
I like that a lot.
Yeah.
Okay.
And again, like Josh said in the beginning, it's easy to swap out a lender if they don't agree with that process because everybody's different, right? Some lenders are lending on property with the intention of selling that note anyway. And so that's why they have
Yeah.
different requirements, right? Whereas some lenders, they want to stay in the deal, they want to keep that deal. And so that's why we're having those variances. But that's also why it's so easy to swap out a lender, if we need to. And people just don't take advantage of that. They don't have to stick with the same one. But they do get tied to those amazing rates or something like maybe one lender has better rates than the other, but you have to then educate your borrower on the reason they're getting those rates is because you're acting like this is your funds when one lender might not allow that, right? So let's not pretend here, just be open with everything, tell the truth, we'll get the deal done. So
Right.
yeah.
And I will add that one advantage of working with someone like Julian, who has access to, I don't know, what is it, 400 or so lenders, is that he can do the swapping for you. You don't, as a borrower, you don't need to go and swap DSCR lenders yourself. Just wanted to add that. Now, Effie, I'll give it to you.
Yeah,
I was just going to say it is time for us to wrap, unfortunately. But I would like for each of our guests to let our listeners know what is their social media handle or where would they like to be contacted. So I'm going to start with Josh. Josh, can you let our listeners know how can they get a hold of you?
Yeah, definitely. I know. I appreciate that. But one thing I do want to lead out the call with is like the people that you have on this call are very experienced individuals. I'm very fortunate to call everybody on this call my friends. So I've worked with each of you and I've learned a ton from Jamey. I've learned a ton from Raz. Effie, I'm getting to know you better. It's been
You're going
great
to
getting
like
to know
me
you.
one day, right?
Julian he's very well connected when it comes from the lender side. So you're from an audience perspective, you have a lot of experience here and a lot of good people to work with. So just keep that in mind. But yeah, the best way to reach me, so it's at Josh Smith REI that's my Instagram handle. The same handle for my YouTube if you're looking for some of the educational content. And then if you are looking for capital or for us to fund your deals, it is www.foundationalfunding.com.
Foundational funding.
Funding.
I like that. .com. Very nice. All right. Jamey, where are you at? Or can they get a hold of you?
You can find me on Instagram at it's Jamey with a Y. I put it in the chat just in case you want to spell it in the description or something.
Okay.
Yeah, we'll add it in the description.
It's Jamey and a Y?
It's Jamey with a Y.
With a Y.
Yeah.
What kind of Y?
I have the word Y, but it's Jamey with a Y.
WHY?
Yeah,
As in,
WHY. Yeah, because everybody complains about my name being spelled wrong with an EY at the end, so I always have to say it's Jamey with a Y, and it just worked out with the wordplay. It's
nice.
Jamey with a Y. Yeah.
Like
yeah.
it.
And then my website is jjcreativecapital.com.
JJ Creative.
Capital.com.
Very nice. I like it. I like it. Julian.
So social media, I'm working on the social media connection, but its easiest way is to go to dealfunding360.com. And there is a apply button there. And also there is a phone number, which also can have access to me through that too.
And that was Deal Funding
360. I put in a chat as well.
Okay. Oh, awesome. Awesome. Raz, you got that? Okay. All right. Well, everyone, I want to say thank you for being here. We're truly honored. And to our listeners, if you gained some information and knowledge, which you should have if you were listening, join us again. We intend to be inviting buyers, sellers, more, funders, more DSCR lenders. We're going to be delving into this subject a fair amount. So join us. And like was already pointed out, you're in really good hands with these three gentlemen. So look them up and connect with them. So
Thank you for the
Effie.
conversation.
Awesome.
Stay-
Thank you, Effie. Thank you, Raz.
Thank
Yep.
you,
you're
Raz.
welcome. Okay, thank you,
Guys.
everyone. Take care. We'll see you next time.